If you've managed to save $10,000, congratulations, because you're already ahead of nearly 40% of Americans who don't have even $400 set aside for emergencies according to the Federal Reserve's latest data. And this puts you in a surprisingly strong position to make some incredibly smart financial moves that could transform your wealth trajectory for decades to come. But here's the thing that most people don't realize when they finally hit that 5-figure savings milestone. How you invest this money in the next few weeks could literally be the difference between retiring comfortably in your 60s or working well into your 70s. And the statistics on this are absolutely staggering when you dig into the numbers. The average American reaches retirement age with just $95,000 in their retirement accounts, according to recent data from Vanguard, which sounds like a decent amount, until you realize that this would give you only about $380 per month if you follow the 4% withdrawal rule, and that's barely enough to cover groceries, let alone maintain any quality of life. So the question isn't really whether you should invest your $10,000, but rather how you should invest it to maximize your returns while managing risk appropriately for your situation. And that's exactly what we're going to break down in detail today, because making the wrong choice here could cost you tens of thousands or even hundreds of thousands of dollars over your lifetime. Now, before we dive into the specific investment strategies, we need to address something that almost nobody talks about, but that could completely derail your investment plans before you even start, and that's high interest debt, because if you're carrying credit card balances at 18% or 22% interest rates, paying those off is technically giving you a guaranteed 18% to 22% return on your money, which is better than almost any investment you could make in the stock market. The math on this is pretty straightforward when you think about it. The average annual return of the S&P 500 over the past century has been about 10% before inflation. So if you're paying 20% interest on debt while trying to earn 10% in the market, you're literally losing 10% per year on that money, which makes absolutely no financial sense whatsoever. According to the Federal Reserve, the average American household carries about $6,170 in credit card debt. And if that describes your situation, you should seriously consider using a portion of your $10,000 to eliminate those high interest balances immediately, because the peace of mind alone is worth it, not to mention the mathematical advantage. However, and this is crucial, I'm not suggesting you should drain your entire emergency fund to pay off debt, because you need to maintain at least 3 to 6 months of living expenses in a readily accessible savings account for unexpected emergencies like medical bills, car repairs, or job loss, which according to a Bankrate survey happens to about 1 in 4 Americans every year. So let's assume you've got your high-interest debt under control and you've maintained an appropriate emergency fund, which means you're now ready to actually invest that $10,000 in a way that's going to build real wealth over time. And the first strategy I want to talk about is something that 95% of people completely ignore, even though it offers the best risk-adjusted returns available anywhere in the financial world. I'm talking about maxing out your employer's 401k match, if you have one available to you, because this is literally free money that your employer is offering to give you just for saving for your own retirement. And yet, according to a Financial Engine study, about 1 in 4 employees who have access to a 401k match are leaving an average of $1,336 per year on the table by not contributing enough to get the full match. Think about that for a second. If your employer offers a 50% match on the first 6% of your salary, and you're making $50,000 per year, that's $100 of free money annually that you're just refusing to accept. Now, assuming you've already maxed out your 401k match, or perhaps you don't have access to an employer-sponsored retirement plan, the next smartest move for most people is going to be opening and funding a Roth IRA, because this retirement account offers something incredibly powerful that most people don't fully appreciate until they're much older. And that's completely tax-free growth and tax-free withdrawals in retirement, which can save you literally hundreds of thousands of dollars over your lifetime. Here's why this matters so much. When you contribute to a Roth IRA, you're putting in money that you've already paid taxes on today, but then every single dollar of growth from that point forward is completely tax-free forever, as long as you follow the withdrawal rules. Which means if you invest $6,500 today at age 30 and it grows to $70,000 by age 65, you get to keep all $70,000 without paying a single penny in taxes on that $63,500 of growth. Compare that to a traditional IRA or 401k, where you'd potentially pay taxes on the entire $70,000 at your retirement tax rate, which could be 22% or even higher depending on your situation. And you're looking at over $15,000 in taxes that you'd completely avoid with the Roth structure. According to the investment company Institute, only about 33% of American households own any type of IRA, despite the incredible tax advantages these accounts offer, which is frankly shocking when you consider how much money people are leaving on the table by not taking advantage of these vehicles. For 2024, you can contribute up to $7,000 to a Roth IRA if you're under 50 years old, and if you're 50 or older, the limit increases to $8,000 thanks to catch-up contributions. So you could invest a significant portion of your $10,000 into this account right away and start building that tax-free wealth immediately. But now comes the question that everyone asks once they've opened their Roth IRA or maxed out their 401k contributions. What should you actually invest in once the money is sitting in those accounts? Because just having money in a retirement account doesn't do anything if it's sitting in cash, earning basically nothing while inflation slowly destroys its purchasing power. This is where a lot of people make critical mistakes because they either try to pick individual stocks thinking they can beat the market, or they get paralyzed by choice and end up doing nothing at all, both of which are terrible strategies according to decades of investment research. The data on this is absolutely conclusive and frankly pretty humbling for anyone who thinks they're a stock-picking genius. According to S&P Dow Jones indices, over 90% of actively managed funds failed to beat their benchmark index over a 15-year period, which means that even professional investors with teams of analysts and sophisticated computer models can't consistently pick winning stocks. So what chance does the average person have of doing better than these professionals who dedicate their entire careers to this? The answer is basically zero, and this is why the smartest investors in the world, including Warren Buffett himself, recommend that most people should simply invest in low-cost index funds that track the entire stock market, rather than trying to outsmart it. When we talk about index funds, what we're really talking about is a simple investment vehicle that owns a tiny piece of hundreds or even thousands of companies all at once, which gives you instant diversification and protection against any single company failing or underperforming. And the beauty of this approach is that you're essentially betting on the American economy or the global economy as a whole, rather than trying to guess which specific companies are going to succeed. A total stock market index fund like VTSX from Vanguard or FSCAX from Fidelity owns literally thousands of companies across every sector of the economy, from technology giants like Apple and Microsoft to healthcare companies, financial institutions, consumer goods manufacturers, and everything in between, which means you're automatically invested in whatever companies end up winning in the future without having to guess correctly today. The historical returns on this approach are remarkably consistent when you look at the long-term data. The total US stock market has returned about 10% annually on average over the past 90 years, including dividends, which means $10,000 invested today would grow to about $174,000 in 30 years if history continues to repeat itself. And that's assuming you never add another dollar to it, which of course you should be doing regularly through consistent monthly contributions. Now I know some of you are thinking that putting all your money into stocks sounds incredibly risky, especially if you've lived through market crashes like 2008 or the COVID-19 panic in 2020. And you'd be absolutely right to have some concerns about volatility, because the stock market can and does experience significant short-term declines that can be psychologically difficult to endure, even when you know rationally that they're temporary. This is where asset allocation becomes critically important, which is just a fancy way of saying that you should divide your investments between stocks and bonds in a way that matches your personal risk tolerance and time horizon. Because someone who's 25 years old with 40 years until retirement can afford to take much more risk than someone who's 55 and planning to retire in 10 years. The general rule of thumb that many financial advisors use is to subtract your age from 110 or 120 to determine what percentage of your portfolio should be in stocks. So if you're 30 years old, you might have 80% to 90% in stocks and the remaining 10% to 20% in bonds, whereas someone who's 60 might have closer to 50% in stocks and 50% in bonds to reduce their exposure to market volatility as they approach retirement. Bonds are essentially loans you're making to governments or corporations that pay you a fixed interest rate over time, and while they generally don't provide the same high returns as stocks over the long term, they're much more stable and actually tend to go up when stocks go down, which makes them a valuable cushion during market turbulence. According to research from Morningstar, a portfolio that's 60% stocks and 40% bonds has historically provided about 8.5% annual returns with significantly less volatility than an all-stock portfolio, which might be the right balance for many investors who want growth but also want to sleep well at night, knowing their portfolio won't drop 30% or 40% during a severe bear market. Here's something else that's absolutely crucial for anyone investing their first $10,000. Or their first million for that matter. You need to think about investment costs because even small differences in fees can compound into enormous differences in your final wealth over decades of investing. If you're paying 1% in annual fees for an actively managed mutual fund versus 0.04% for a low-cost index fund like those offered by Vanguard or Fidelity, that might not sound like a big deal on the surface, but over 30 years on a $10,000 initial investment growing at 9% before fees, the high-fee fund would leave you with about $106,000, while the low-fee fund would give you about $132,000, which is a difference of $26,000, or nearly 25% less money just because of fees. According to a study by the Center for American Progress, the average American worker will pay about $138,000 in 401k fees over their lifetime, which is absolutely staggering when you consider that this money could have been compounding and growing for their benefit instead of lining the pockets of fund managers and financial intermediaries. This is why I'm such a strong advocate for low-cost index funds from providers like Vanguard, Fidelity, or Schwab, because they offer expense ratios that are often less than 0.05% per year, which means you're keeping virtually all of your returns rather than giving away a significant chunk to fees that provide almost no value in return. So let's bring this all together into a concrete action plan for your $10,000 that synthesizes everything we've discussed and gives you a clear roadmap for moving forward. First, if you have high interest debt above 8% or so, seriously consider paying that off before investing, because the guaranteed return usually beats what you'd earn in the market. Second, make absolutely certain you have at least 3 months of living expenses in an emergency fund before you start investing beyond your 401k match, because you don't want to be forced to sell investments at a loss during an emergency. Third, contribute enough to your 401k to capture the full employer match if one is available, because that's free money you simply cannot pass up. Fourth, open a Roth IRA and contribute as much as you can up to the annual limit, because tax-free growth is incredibly powerful over decades. And fifth, invest your money in low-cost diversified index funds with an asset allocation between stocks and bonds that matches your age and risk tolerance. Then commit to adding money consistently every month, regardless of what the market is doing, because time in the market beats timing the market every single time, according to countless studies. If you follow these principles with your $10,000 today and continue following them with every dollar you save going forward, you'll be setting yourself up for financial success that will compound into hundreds of thousands or even millions of dollars over your lifetime. And you'll be able to retire with dignity and security rather than becoming another statistic of Americans who reach 65 with almost nothing saved. If you found this helpful, and you want more practical financial advice that's based on real data and research rather than get-rich-quick schemes, make sure to subscribe to the channel and hit that notification bell so you do not miss future videos. Because we're building a community of people who are serious about taking control of their financial futures and creating real wealth over time.